Welcome to the Financial Freedom Secrets Show. This is your host, Jackson Millan, the Wealth Mentor, helping business owners create financial freedom faster by mastering the language of money. Want to see how well you're tracking towards financial freedom? Complete our 40-point financial performance scorecard at wealthhealthcheck.com.au. That's wealthhealthcheck.com.au. The average score for most business owners is 18 out of 40. So complete the scorecard now and see how well you're tracking towards financial freedom. G'day guys, this is Jackson Millan, the Wealth Mentor, and I'm here for another episode of the Financial Freedom Secrets Show. And in this episode, we're going to be going through the playbook for the Aureus Simple Strategy System. If you've joined us for the last couple of podcasts, we've been going through our signature system, where I've been taking you through each of the playbooks that supports how we've helped our clients to amass over $3 billion in combined wealth. And what this comes down to is ultimately having a proven process, focusing on taking the right actions, and ultimately ensuring that we are optimizing and improving our trajectory to create financial freedom. Because financial freedom doesn't happen by mistake. It is about having the first pillar of define, getting crystal clear on what it is that you want, why you want it, of ensuring that you've got the right mindset to support it, that you've developed a roadmap that gives you clarity around the exact direction that you're heading to achieve all of your lifestyle and financial goals. And then now we need to support that with a simple strategy, a strategy that you understand, a strategy that you trust, a strategy that you can stick to. So I'm going to provide you with the playbook. Now, if you'd like to get a copy of this, make sure that you jump onto wealthhealthcheck.com.au and complete the financial performance scorecard. You'll get access to the previous podcasts and the previous playbooks, along with our collection of best calculators, tools, educational guides, and resources that will help you implement. So let's get started in. So if I share my screen here, the Aureus Simple Strategy System is basically how business owners go from being broke to rich and ultimately stay that way. Because ultimately you're going to discover the exact same wealth building system that's created more millionaire business owners than any other method that I've ever seen. Because the reality is the vast majority of wealth building methods are not built for business owners. And business owners' wealth journeys are fundamentally different. This isn't theory. This isn't fluff. This is the real deal. And if you follow it as it's written, you will ultimately build more wealth than you know what to do with. And here's what I mean. When we've got this system in place, we have clarity around creating financial freedom. We overcome the obstacles of not having a plan, of not having cash, of not having consistency, and we have the ability to define and get crystal clear on what it is that we want. We then create and make money work harder for us. And then we manage it so it continues to nurture, build, and grow. And this is the critical parts of working towards creating financial freedom. It is a simple system. It is a sustainable system, so you can stick to it for the long term. And it is a scalable system, meaning that as your business continues to build and grow, this system will continue to grow with you. So here is the brutal truth about business owner wealth. Most business owners are frankly idiots when it comes to money. They make decent income, sometimes great income, but they are still broke. Why? Because they think making money and building wealth are the same thing. They are not. Making money is what happens in your business. Building wealth is what happens after you pay yourself. And this is where most people screw up in business. They treat their personal finances like a hobby instead of a business. And this is a big mistake. So here's what the rich guys do differently. They implement a simple strategy framework, and it starts with what we call the one-page wealth plan. So let me talk you through it. There are 4 components to the system. One is the foundations. Stop the financial bleeding and create your money machine. 2, the wealth buckets. We put your money where it makes you more money. 3, we have the freedom number. We calculate exactly when you never have to work again if you don't want to. And then 4, we've got the legacy machine. We make sure that your impact outlives you. So let's break down each one of these for you. Let's start with the foundations, building the money machine. This is where most people fail. They want to jump straight into investing and making millions, but you can't build a skyscraper on quicksand. So we start here. And we start with plan A. This is about creating your cash surplus machine. So step 1, we need to get crystal clear on your goals. Here's what I want you to do. Grab a piece of paper and write down exactly what you want your life to look like in 20 years. Like, be specific. I'm talking stupidly specific. Where do you want to live? What do you want to drive? How much money do you want to have? What does your typical Tuesday look like? The issue is that most people have fuzzy goals, and fuzzy goals create fuzzy results, okay? Rich people have laser-focused goals, and that creates laser-focused results. So ask yourself these questions. Like, have you created and updated your 20-year roadmap? What has been achieved? Have any of your priorities changed? Are there any new goals that are top of mind? And do you feel like you're on track? If you missed the last episode of the podcast where we went through the real roadmap, we spent an entire session and have a complete playbook around how you do that. So if you haven't done that yet, it might make sense to pause this, go back and do that first. Now, write down your answers and keep them somewhere where you can see them every day. Next, you need to fix your money mindset. Now, this might hurt a little, but most business owners have screwed up relationships with money. They either worship it or they hate it, and neither of those harsh realities work. Money is a tool, that is it. It's like a hammer or a screwdriver. We utilize it to achieve a particular goal. You need to get comfortable with having lots of it, keeping lots of it, and using it to create the life that you want. So answer these questions honestly. How are you feeling about your relationship with money? Like, what is dominating your thinking around your money right now? Where do you need to focus your energy between lifestyle and financial? And what is impacting your peace of mind? If any of those answers make you uncomfortable, we need to fix that first. So if you go back 2 podcast episodes ago, we spent an entire session about the money mindset, and we have a playbook to support that as well. So I advocate that you go and consume those resources to support this. Next, step 3 is building your cash flow machine. This is where the magic happens. You're going to create what I call the hub structure. Here's how it works. All of your income goes into one account. I call this your hub. And from there, money gets automatically distributed to living expenses, tax obligations, investment accounts, emergency funds. The key is automation. Like, rich people don't rely on willpower to build their wealth. They rely on systems. So ask yourself, how is the hub structure working for you right now? Are you on track to hit your surplus target? Are there any unplanned expenses that we need to consider? And what else can you do to increase your income? The target here is to find the dollars per month in surplus cash, because it's not your earned income that makes you wealthy, it's what you do with it that counts. We're going to be doing our next podcast episode on creating killer cash flow and sustaining surplus, so stay tuned for that episode. If you can't find surplus cash, you don't have an income problem, you have a spending problem, okay? Now, step 4, we need to create the roadmap. Once again, we covered this off in the last podcast episode. Now we need to turn your goals into a step-by-step action plan. This isn't wishful thinking, this is project management for your wealth. So every goal needs to get broken down into specific actions that are required. We need deadlines for completion. We need to work out who's responsible. Usually it's going to be you. And you need to work out how you're going to measure your progress. So ask yourself, how confident are you to take the required actions to stick to your roadmap? Do you know the milestones we need to hit over the next 12 months? What could get in the way of achieving your milestones? And what can we automate or accelerate on your roadmap? This forms our plan A. So now we shift to plan B, building your peace of mind foundation. So step 1 is creating your war chest. Before you invest a single dollar, you need a war chest. Like, for many people, this might be 2 to 3 months or potentially 6 to even 12 months of expenses that are sitting around in a boring savings account. We're going to talk a little bit about not having it there doing nothing. And you might be thinking, but like, what if I invest this money and I make more, right? What could I do? Stop. This isn't about returns. This is about sleep at night money. Like, when you have a proper war chest, you make better investment decisions. You don't panic sell. You don't take stupid risks. It fundamentally changes your mindset. So ask yourself, how much do you have in your war chest right now? What would you need to have in the bank account to self-insure against the unforeseen, the things that keep you awake at night? And is it stored in the most suitable place to maximize returns and to maintain liquidity? This is really important. Now, step 2, get the right insurance. Insurance is boring, but it's essential. Here's the rule. Insure what you can't afford to replace and self-insure everything else. Your life, your ability to earn an income, your health, these things need insurance, right? Your phone, your laptop, your car's paint job, they probably don't need insurance. So ask yourself, do you understand what you're currently outsourcing to an insurer? Are there any new risks that you need to consider? Is it debt? Is it kids? Anything else? Are there any ways to optimize your costs? So do you pay annually? Are there certain risks that you're going to start self-insuring? Are there risks that you could reduce? Important questions to ask. Step 3, set up your wealth structures. This is where most business owners leave money on the table. Like, you need the right legal structures to minimize your tax, to protect your assets, and to maximize your investment returns. The structures you need depend on how much wealth you have. So, starting out, you keep it simple. Maybe you keep everything in your personal name. Growing wealth, we use a family trust and a bucket company for tax optimization. For serious wealth, and as you start getting closer to preservation age, we start using superannuation and investment bonds. So ask yourself, do you feel like you have the right structures in place to build wealth effectively? Do you have all of your investments owned in the correct name and entity? And has your accountant reviewed your structure in the last 12 months to ensure that you're building wealth in the right place? Step 4, get your estate planning sorted. Nobody likes thinking about death. Do it anyway. If you die tomorrow, what happens to your wealth? What happens to your business? What happens to your family? If you don't know, you need to fix that today. So here are the minimum requirements. You need an updated will. You need an enduring power of attorney, which is for financial decisions. You need an advanced health directive, which is for medical decisions. And you need a binding death benefit nomination for your superannuation. You may also want to consider having what's called a testamentary discretionary trust if you have young kids or at-risk beneficiaries who might be spendthrift or have a heightened or increased risk of being litigated or pursued for those funds. That is something we can talk about separately. And the idea here is that as a result, we come up with a peace of mind target. On a scale of 0 to 100%, how much peace of mind do you have around your plan B? You should feel completely confident about your financial security. So part 2 is the wealth building buckets. This is where your money goes to make babies. This is where we get to the fun part. You're going to divide your surplus cash into 3 buckets. So we've got our short-term bucket, which is usually 0 to 2 years. We set a target amount. This is your opportunity fund. This is when a great investment comes around, you can grab money from here. When your business needs capital, you can grab money from here. When life happens, you can grab money from here. So usually this is sitting in high interest savings, in term deposits, in cash management trust, or potentially in your offset account against your mortgage. So we use it for business opportunities that can't wait, for equipment purchases, for property deposits, for emergency repairs. Then we've got our medium-term bucket. This is 2 to 10 years, and we set a target amount here. This is your lifestyle fund. This is where your money funds your medium-term goals and dreams. So we usually keep this in managed funds, ETFs, property trusts, blue chip dividend shares, and we use this for house upgrades, kids' education, business expansion, major holidays. And then we've got a long-term bucket, which is 10 years plus. This is your freedom fund, and we want to set a target for this. And this is the money that's here that ensures that you never have to work again. So we usually keep this in growth shares and ETFs, in investment property, in business investments, and in superannuation. The typical uses here is retirement funding, generational wealth, philanthropic goals, and then ultimate financial security. So the allocation formula depends on your risk tolerance. And there are a couple of considerations here that for most of our clients, they find themselves in one of these buckets. They're either conservative investors, meaning they put 30% of their wealth into the short-term bucket, 40% into the medium, and then 30% into the long. A balanced investor puts 20% into the short, 30% into the medium, and 50% into the long-term bucket. And then aggressive, they put 10% into the short term, 20% into the medium term, and then 70% into the long term. This really depends on your age, your risk tolerance, and your goal. So it's really important that you seek advice to work out what's the right risk profile that aligns to you and your goals. So now we get to part 3, the freedom number. When you never have to work again, or you have the ability to choose, and this number changes everything. Your freedom number is the amount of passive income that you need to maintain your lifestyle without working. So, step 1, you need to calculate your annual expenses. So add up living expenses, insurance premiums, tax obligations, fund money, also a buffer for inflation. Work out what those annual expenses are. And then you need to choose your freedom strategy. There's basically 3 options. Option 1, which is the easiest, is spend it down. The plan is that we want to have that wealth last for 20, 30 years or so, right? And the idea is that we are drawing down from the smallest capital base and we're eroding the capital over time. The risk is that you might outlive your money, but it drastically reduces the amount of wealth that you need to accumulate. Option 2 is preserve the capital. You live off the investment returns only. You keep the capital intact forever. And the idea here is that we focus on preserving that capital. So there is a decent sized nest egg that gets paid to your beneficiaries in the event of your passing. It also provides you with more peace of mind that if there are other expenses that come up along the way, that it isn't going to completely throw your financial freedom off track. And then option 3 is generational wealth. The capital keeps growing while providing income, and this ultimately builds wealth that lasts forever and ultimately sets up the future generations substantially. So what this basically means is that you've got so much wealth that you can't even spend the returns. And that continues to compound and grow in perpetuity. And this requires the largest capital base, okay? So there's a couple of ways that you go about this. And we can basically work out annual expenses, the spend down strategy, and multiply that by 20, okay? And that gives us a rough idea of how much we need. The preservation strategy is that we take the annual expenses and we divide that by 0.04. And that gives us the capital reserve strategy. And then if we look at generational strategy, we want to have annual expenses and we divide that by 0.03. These are some back of the envelope calculations. We have a comprehensive financial freedom forecast tool on the Wealth Health Check. So if you go to wealthhealthcheck.com.au, complete the scorecard, and in the bonus resources, there is a financial freedom forecast tool where you can do this modeling in a bit more detail. So this will basically tell you then the target. Well, how long do I have to achieve it? So if I want to be financially free by the time I'm 50 and I'm 40 now, I've got 10 years to go. So this is basically our runway to get there. Now we get to part 4, which is the legacy machine, how you will be remembered. Money's just the beginning. The really successful people think beyond their bank account. They think about their impact, their influence, their legacy. And here's how to build yours. Define your impact. Ask yourself, what change do you want to help create in the world? Who do you want to help? Is it just family? Is it friends? Is it community? Are there charities or foundations that are dear to your heart? What causes matter most to you? And how do you want to be remembered? Write this down. Make this your mission statement. Then we need to plan the wealth transfer. When should wealth transfer happen? Is this something that you want to wait until you pass away? Or is it something that you actually want to do during your lifetime so you can actually see the impact that that wealth has? How much goes to family versus charity? What conditions should be attached? And how do you prepare the next generation? I wrote a book about this called The Family Vault, How to Create Generational Wealth and Keep It. So if legacy and wealth transfer is important to you, I'd advocate reading that book. And then create your giving strategy. The smartest wealthy people give while they're alive. Why? Because they get to see the impact. They get to guide the process. They get to enjoy the satisfaction. So consider annual charitable giving targets, private ancillary funds, family foundations, direct impact investments. So what I've included here for you guys is a series of questions that align to each part of this system. So then you can ask yourself some questions to self-assess and see where your priorities are. So let's get into the next part. Let me just make this a little bit smaller so you guys can see this. This is the Wealth Tactics Toolbox, and these are the primary strategies that we use for our clients when it comes to building their simple strategy system. And we break this down into cash flow, structure, debt, investments, risk management, and estate and legacy planning. So let me run you through these one by one. So let's start with the cash flow tactics. Tactic 1 is the income explosion. If you are not hitting your surplus targets, you need to consider how you grow your income, because I feel it's far easier to grow your income than it is to cut your expenses. So the method, stop thinking like an employee. Start thinking like an entrepreneur. Every business owner should be working towards 3 to 5 income streams. So your main business, investment income, consulting income, digital products, licensing, whatever that might be. So list your current income sources, identify how you can optimize those sources, or potentially pick some new ones to continue to build. Work out the ones that are the easiest to implement, set a 90-day launch deadline, and then execute relentlessly. Focus on growing your income each and every single quarter, and your ability to build wealth will be a whole lot easier. Tactic 2, the expense massacre. You're spending like a drunken sailor. Every expense needs to justify its existence. So ask, does this expense directly contribute to my wealth building or my happiness? If the answer is no, we need to kill it, okay? This is not about living on cornflakes for dinner. This is about controlling our expenses, okay? So track every expense for 90 days. Categorize the essential versus the nice to have. Look for opportunities to eliminate the nice to haves that don't actually really add significant value to your life. For many of our clients, it's up to 50% of what they're spending. Negotiate better rates for your essential expenses. Set monthly expense targets and stick to them. And if you go through this process and you feel like there's nothing that you can cut, you need to go back to tactic 1 and grow your income. Tactic 3, the hub structure implementation. This is the cash flow controller. Like when your money management is complete chaos and you're bleeding cash everywhere. Most business owners have no idea where their money is going. And the hub structure isn't just another boring budget. It's a complete financial operating system that has increased our clients' surplus cash flow by upwards of 40%. So if your current surplus is 10 grand a year, that's potentially an extra 4 grand a year. The reality is for most of our clients, we're talking if they've got a surplus of $30,000 a year, that's a substantial increase of their surplus each and every single year that they could be using for wealth building. Like even just $4,000 extra invested at 8% returns over 30 years is an extra $490,000 in wealth, all from fixing your cash flow structure. So all income flows into one account called the hub. From there, it automatically gets distributed into fixed expenses, your bills, your holiday fund, your personal spending, and your war chest. The important thing here is you need to pay yourself first. Wealth building happens before you spend the money, okay? So there's action steps for you to go through. We're going to be doing next podcast episode going through this in detail. But the split here is you should be aiming towards 50% of your household income on necessities, 30% on discretionary, and a minimum of 20% on wealth building. That's the goal. The pro tip here is if you've got a mortgage, use offset accounts instead of savings, and you could potentially be saving 6% off your mortgage as opposed to paying 2% interest. Now, for many of our clients, we use a platform called My Prosperity that allows us to get data feeds for all the personal bank accounts and run it like Xero for your personal finances. It's $25 a month and it automates all of the tracking and gives you real-time visibility. So if that's something that you'd like to get access to, feel free to reach out to us and we can have a conversation around getting that set up. And the result here is complete cash flow control, automated wealth building, and surplus cash appearing like magic. So go and set this up. And if you're still on the fence, make sure that you tune into the next episode because we're going to go deep on this. War chest building. You don't have a financial buffer. Like emergency funds aren't sexy, but they're non-negotiable. Minimum 2 to 3 months of expenses. For many people, it's working to 6 to 12 months of expenses. Put it in a high interest account or put it in the offset and make sure that you don't touch it unless it's a real emergency. Offset and redraw. So if you have a home loan with an offset facility, instead of having it sitting in a bank account making 2%, put it in your mortgage and get a 6% return, basically guaranteed. Because the idea is that if you have a mortgage that you're paying, say, 6%, and it's on your principal place of residence, you're paying that in after-tax dollars. So you've got to earn money, pay tax to then pay the 6%. That essentially works out to about an 8% pre-tax return. And for every dollar you've got in a mortgage, it's a dollar you're guaranteed to not pay interest on. So for that reason, it is a risk-free return. So make sure that you're reviewing this and leveraging your offsets wherever possible. Now let's talk about structures. Personal ownership. This is the starting point for most people who have simple affairs. It's simple, it has no compliance cost, it's easy to understand, but you outgrow it fast. Why? Because you have no flexibility and it forces tax outcomes. For example, if you own an investment property in your own personal name and it's positively geared, you have to pay tax on that individually. If you sell that property, you have to pay tax as an individual. And that could potentially mean 47% tax. So just make sure that you are reviewing this, that you understand that you've got the appropriate protections, and that you understand when you transition to the other structures based on your wealth growing. Tactic 2 is the family trust. This is the wealth multiplier. When you're making good money and you want tax optimization, and the reason why it works is flexibility is everything. It gives you the opportunity to have flexibility in every single year of how you distribute that income to family members that are lower tax and potentially to a corporate beneficiary. So the idea here is we're not going to pay any more than 30% tax on average. Idea is we pay less tax, you keep more money. So you need to speak to an accountant or a tax lawyer in order to establish it for you. Typically it's between $2,000 and $5,000 depending on the complexity of what you're looking to do. We set up the ABN and the TFN. We open the trust bank accounts. We set up or potentially transfer the appropriate investments into the trust. And then we work with our accountant around that distribution planning. Make sure you get advice on this. Tactic 3 is the bucket company. This is the real tax saver. So when you're in the top marginal tax bracket and you want to retain profits at a lower tax rate, the company tax rate is 30% compared to personal being 47%. Do the math. So we utilize this usually when our clients are earning over $200,000 in income. We establish the company as a trust beneficiary. We distribute income to the company when it makes sense from a tax perspective. We maintain the company compliance. We plan future distribution strategies, and then we monitor the franking credits, because when we pay tax personally, you basically write off that tax. It's paid, there's no recourse. However, a company accumulates franking credits for the tax that it's paid. So if you pay that 30% tax and we accumulate that over the rest of your working life, and you get to a stage whereby you're not working anymore, we can distribute dividends from that bucket company. And if you're at a lower tax rate than 30%, you will get a refund for those franking credits, which means that you basically get the tax back. This is a really, really powerful position that many of our wealthy clients use. Now, investment bonds. This is a really, really cool strategy. It is a set and forget option. And the idea is you want growth without the tax headaches. So the thing about an investment bond is that you pay tax inside the bond at 30%. So it kind of operates like a bucket company. The difference being is that it has no annual tax returns. And if you hold it for more than 10 years, it becomes CGT free. It also has automatic estate planning. So this is a really, really powerful strategy. Now, what we do is we do this for busy business owners. It's great wealth building alternative to superannuation, and it's great for kids' nest egg funding. So we work with our clients to set up the appropriate investment bonds. Not all of them are made the same. We choose the right investment option to ensure that it's invested appropriately. We set up a regular contribution plan and we review it annually to increase the contributions up to 25%, because there is a rule that's called the 125% rule. So you can only put in 125% of what you put the previous year. So if you put in $1,000 this year, next year you can put $1,250. And if year 3 you put in 0, in year 4 you can't put anything, because if you breach the 125% rule, it restarts the 10 years, which is something that we definitely want to avoid at all costs. We keep this and hold it for a minimum of 10 years. If you do draw it down before 10 years, you just have to pay the top-up tax on the 30% already paid. And we just monitor the performance, but we typically don't tinker. Tactic 5, super, the retirement rocket. Now, long-term wealth building, and typically for our clients who are over 35, where the stretch to preservation age being 60 plus, isn't that actually far away. Why it works is because we pay average 15% tax going in, we pay 10 to 15% tax on growth, and then once we're in pension phase over the age of 60, there's 0% tax. So this is the best long-term wealth building vehicle. So what do we consider? Well, we consider maximizing our concessional or our pre-tax, tax-deductible contributions. We can contribute up to $30,000 a year. We consider non-concessional contributions. So if you've got extra money laying around and you don't need it for your short and medium-term buckets, we can make additional after-tax contributions. We can evaluate a self-managed super fund versus industry or retail fund. So many of our clients who have household super balances of over 300,000, we consider looking at setting up a self-managed super fund, which basically allows us to go and acquire direct property through the super fund, which is a really cool strategy. We plan for transition to retirement strategies of how do we actually start utilizing that money sooner, and then we review the investment choices. We want to make sure that we've got a really good strategy there. Now, our debt tactics, bad debt elimination. If you have any non-deductible debt, so bad debt like credit cards, car loans, personal loans, or even your principal place of residence mortgage, these are bad debts, and bad debts is like a cancer. So we want to cut it out fast. We want to focus on trying to kill them all. So we eliminate the debts and we list them all based on the balances and interest rates. We pay minimums on everything except the highest interest rate debt. We attack that high interest rate debt with everything that we've got. And once cleared, we move on to the next highest rate. And we should celebrate whenever we eliminate that debt. Cool? The good debt acquisition. This is the wealth accelerator. When you've got good surplus cash flow and you want to amplify your returns, we need to understand that not all debt is bad. It's a magnifier, okay? And investment debt allows you to buy more assets than you could with cash, and that increases our cash on cash returns, but only if the numbers work. So we want to work with our advisors to create a strategy to work out, can we get cash flow positive investment opportunities, or if it is negatively geared, that we've got the cash flow to support it. We get our pre-approvals, we know what our borrowing capacity is. We try and keep our total debt servicing under 30% of our gross income, because we don't want to have too much of our household income going to servicing those debts. We want to structure the loans for maximum tax deductibility, which usually means interest only. And we monitor investment performance versus the debt costs quarterly. Next is debt recycling. So this is how we combine bad debts, good debts, and investments to compound your wealth really, really quickly. So if you've got non-deductible debt primarily on your principal place of residence, and you've got investment assets, it allows us to turn bad debt into good debt, to acquire more investments, and to ideally pay the bad debt off faster. So there was a detailed strategy on this that we'll be covering in a couple of podcasts' time when we start talking about automated investments. The idea here is we have the same debt level, but we have a much better tax position, and it allows us to compound our wealth a whole lot faster. Let's talk about the investment tactics. So, property investment. This is the Aussie favorite. You want leverage, you want tax benefits, and you want tangible assets. We ideally buy property that somebody else wants to pay through rent, right? And the idea here is by buying property, we get rental income, we get capital growth, we get tax deductions, and we get the benefits of maximizing our cash on cash returns through leverage. So we want to make sure that we're using the right investment philosophy. We're researching high growth and potentially high yield locations. We make sure that we've got our finance and our pre-approvals in place. Business owners really struggle with getting access to debt because they haven't got their right financial strategy. We use a buyer's agent who helps us do that due diligence and to locate the best markets and to negotiate, because this is a very high risk and complicated strategy. Unless you are an expert and you want to master the skill of asset selection in property, outsource it to somebody who does this full time. Make sure that you do the right due diligence around building and pest inspections, set up property management and your depreciation schedules, and rinse and repeat. Now, business acquisition. This is my preferred strategy for wealth acceleration. This is the expert's choice. It does require you to have expertise. It is an active wealth strategy. So if you've got industry expertise and you want active involvement, you should buy businesses that you understand. You improve the operations, you grow revenue, you extract more profits. It has higher returns than passive investments, but it does require more work. So there is a process of identifying target businesses in your area of expertise, engaging business brokers or direct approach owners, complete thorough due diligence, financial, operations, legal, structure the deal with appropriate financing, implement improvements, strategies as quickly as you can to extract more value. I'm going to do a detailed masterclass on this in the future. Tactic 3, share market investing. So the wealth building workhorse. You want liquidity, you want diversification, you want long-term wealth. Buy pieces of great businesses at reasonable prices. You hold it for years, typically reinvest the dividends, let compounding interest work its magic. The ways to go about this is set up a share trading account with a low-fee broker. Consider starting with a low-cost, say, an ASX index fund, like an ETF, for instant diversification. You can also get globally diversified ETFs. Make sure that you get advice around this. Add individual quality dividend-paying stocks. Set up dividend reinvestment plans. Review and rebalance annually. Now, it's important. If you're going to pick stocks, do your research. Don't just throw darts at a dartboard. Tactic 4, manage funds, the professional approach. You want expert management and diversification. You pay a professional to manage your money. They do the research, they make the decisions, they send you the reports. You just focus on your business. And the idea here is if we're going to use a professional manager, an active manager, we want managers that have a long-term track record. So they've got a 10-year plus track record of outperforming the index. We select funds that are aligned with your risk tolerance and goals. We ideally set up a regular investment plan, and then we monitor the performance versus the benchmark so we're not in underperforming investments. And then we review that selection over time. Now, if you want the lazy millionaires method, we do index fund investing. So this is when you want market average returns with minimal effort. We buy the whole market, we pay minimal fees, we get market returns. It's boring, but it's effective. And it's my preferred method of investing in the share market. Even Warren Buffett recommends this for most investors. So select a broad market index fund. It could be ASX 200, the S&P 500. There are even diversified index funds across the whole world. Set up an automated monthly investment. Reinvest the distributions. Ignore market volatility and media noise. Stay the course. And obviously review your ongoing contributions over time. Really, really simple. Risk management, self-insurance. You have substantial assets and liquid reserves, and this is the wealthy person's choice. So instead of paying insurance premiums, you could build a bigger cash reserve and become your own insurance company. So calculate the maximum potential losses that you could handle. Build reserves equal to 2 to 3 times this amount. Invest the reserves in liquid, accessible investments. And then review your adequacy on a quarterly basis as your wealth grows. And only insure catastrophic risks that you can't self-fund. Then we get to life insurance. This is the income replacement machine. So there are people in your life that probably depend on your income. So how do we replace your income and pay off your debts when you die? It's simple, it's essential, it's cheap, particularly when you're young and healthy. So the action steps. Usually it's a calculation of 10 to 20 times your annual income as a coverage amount. We get quotes for life insurance. Now, not all of them are made the same, so we want to consider cost versus the benefits. Consider the ownership through superannuation for tax benefits. Make sure that you get through the medical underwriting quickly, and then review your coverage on an ongoing basis. Tactic 3, income protection, the cash flow guardian. So once again, your income depends on your ability to work. So if you get sick or injured and you can't work, it recovers your income. It's probably the most important insurance that most people don't really think about. So we calculate the appropriate benefit. On average, most insurers cover about 75% of your current income. Depend on your savings buffer. Consider the waiting period of how long you would need to wait to start getting payments before you receive that money. Obviously, the longer the waiting period, the lower the premium. For many of our clients, they choose 30 or 90 days, depending on their savings buffer. We usually use an own occupation definition, meaning that it insures you against the job that you're doing currently. And consider superannuation contributions in your coverage. So, of course, if you're off work for a period of time, you also have the ability to contribute to super. And ensure that that policy is portable if you change jobs, so meaning that if your career changes, we have the ability to maintain that policy. TPD insurance, the lifestyle protector. So this gives you a lump sum for lifestyle changes if you are permanently and totally disabled. So it's a lump sum benefit, and it's usually to pay off the mortgage, cover home modifications, ongoing care costs. So most people do have a proportion of this in super. Calculate any additional income that you might need as a result of that. Compare any occupation versus own occupation. So any occupation is any job that you have experience, training, or education to perform, which is quite ambiguous. And consider integration with other insurance policies. And obviously review that as your lifestyle and your debt changes over time. Now, trauma and critical illness. This is the treatment fund. So you want to maintain your lifestyle during serious illness treatment, right? So if you have a cancer, a heart attack, a stroke, something like that, this pays out a lump sum on the diagnosis, irrespective of whether you're working or not. This is critical because for many people, when they have a cancer, a heart attack, a stroke, they may not be off work for a very long period of time. They may be medically able to go back to work, but what we find is for many of our clients, they're just not ready. And if they rush back to work, that extra stress and pressure can result in other issues. So this amount is to give them some flexibility for 1 or 2 years to have choice around what they do. So you want to make sure that you review the conditions that it covers. Most policies cover 30 plus conditions. Assess your family medical history. So is there a family history of breast cancer, colon cancer, testicular cancer, whatever that might be. Make sure that you consider the things that affect your sleep at night factor, so then you can insure for the things that are potentially higher risk for you. Compare the waiting periods. Most policies have an exclusion period of 90 days from when the policy gets in place. I had a particular client who took out a trauma policy early in my career. She went overseas for a holiday, and when she came back, a couple of months after, she called me and was diagnosed with breast cancer. And because of the policy that we'd chosen, the 90 days started from when we submitted the application, not from when the policy went into force. And I believe it was about 95 days after we submitted the application, and she ended up getting a $500,000 trauma insurance payout as a result of that. So there are technicalities that can catch you up. Make sure that you consider stepped versus level premiums based on age. So stepped means that as you get older, it gets more expensive. Level means you pay more now, but it's locked in for age-based increases. And then review policy exclusions and limitations carefully. And then we've got estate planning and legacy planning. So will creation. Make sure that you've got a will. It's an essential document. If you're an adult with any assets, you need to make sure you've got it. And it's the legal instructions of what happens to your things when you die. Without one, the government decides, and you probably won't like their choices. So take the time to list your assets and their current values, decide who gets what, choose an executor who is going to basically project manage your estate and ensure that your actions, your wishes are carried out. Nominate guardians for minor children, and then review this every 3 to 5 years if your circumstances change. 2 is the power of attorney. This is the decision maker. This is who you want to control in the event that you can't make decisions anymore. And this is for financial decisions. So if you're incapacitated, what happens? And this is particularly around the business, like who can transfer money, who can pay payroll, who can deal with the operating decisions of the business in the event of something happening. So choose different people for medical and financial powers. Discuss your wishes and expectations with the people that you appoint. Engage a lawyer who can complete that enduring power of attorney document. And in fact, the individuals that you appoint need to get their own legal advice. So it's important that you have these conversations. Provide copies to the key people that need to know and review this every 3 to 5 years. Now, tactic 3, testamentary trust. This is the wealth protector. So your beneficiaries need protection from themselves and also from others. So we set up a testamentary trust as a component of the will that only gets established in the event that you pass away. And it holds those inherited assets and it protects beneficiaries from their own poor money management. So for example, we generally have a rule that kids don't get access to the money until they're 25 or 30. We appoint a trustee that they have to liaise with to get access to the money. It protects against relationship breakdown. So if you leave money to your kids and they get married and subsequently divorce, the spouse can't get access to that money. It protects against creditors and lawsuits. So if something happens, they get sued, that money can't be touched. And it does provide tax optimization opportunities, particularly for minor beneficiaries. So a testamentary trust is taxed as an adult, irrespective of whether the kids are under 18 or not. So that creates a lot of value. So if you've got young kids and a decent amount of wealth, having a testamentary trust is a really valuable consideration. So we need to identify beneficiaries who need ongoing protection. You need to choose a suitable trustee, whether that be a professional or a family member. You need to define distribution criteria and restrictions. So is there a certain age? Are there certain activities that they can and can't do? Certain things they can't fund? Include a testamentary clause, trust clause in your will, and obviously communicate that structure and reasoning to your family. You need professional estate planning advice for this. That also goes for the insurance stuff as well. Tactic 4 is really simple, is superannuation nominations. This is your super control line. If you've got it's any superannuation balance, but particularly if it's significant, you can direct where your super fund benefits go by just setting up a binding death benefit nomination. The thing to be mindful of is that most death benefit nominations expire every 3 years. So it's worthwhile reviewing. We see a lot of people who've had them and they've expired and they haven't renewed them. And as a result, it means that the trustee of the super fund can now choose who gets the money, which can create some uncertainty for your loved ones. Now, tactic 5 is the charitable giving structure. This is the legacy multiplier. So if you want to have a lasting impact beyond your family, you need to consider the structure for maximum impact and tax benefit. So this could be private ancillary funds, public ancillary funds, direct donations, testamentary charitable bequests. So for example, as part of my estate planning, I'm setting up testamentary trusts that are specifically for charitable purposes, and that is going to be facilitated in the event of my passing. So define the causes and organisations that you want to support. Calculate the annual benefit. So is it 1 to 5% of income? Research the appropriate giving vehicles for your situation. Set up that systematic giving plan and then obviously track the impact and adjust the strategy accordingly. So there's a lot of stuff here, guys. And although this is simple, there is a lot to it and there are going to be different priorities and focuses over time. So we've created a wealth building action plan. What are the things for you to do in the next 1 to 2 weeks? The foundational assessment. Make sure that we get those foundations right. Weeks 3 to 4, the structure setup. Speak to a good tax advisor to help you review how you structure things appropriately. Make sure you've got the hub structure in place. Weeks 5 to 8, investment implementation. How do we set up the right buckets? How do we open the investment accounts? How do we set up the automations? How do we do the research? And then how do we monitor? Weeks 9 to 12, optimization and systems. We set up that freedom figure and the target timeline. We define the legacy goals and the impact statement. We set up this quarterly review calendar. We create performance tracking tools, whether it be MyProsperity or a spreadsheet. And then we work out the next phase of our wealth building activities. And then we do monthly reviews. Surplus versus target, review investment performance, progress towards goals, opportunity identification, and then reviewing our peace of mind score. And then our annual reviews. Do a comprehensive strategy review, rebalance investment portfolios, update insurance cover, review and update estate planning, adjust goals and target baselines based on that progress. And the bottom line here is, guys, the system works, but only if you work the system. Like most people are going to go through this, get excited and do nothing. Don't be most people. Pick one tactic, implement it this week, and then pick another. Your future self will thank you. And if you follow this blueprint exactly as it's written, you will likely have 95% more wealth than most business owners. So if you need help, make sure that you jump onto wealthhealthcheck.com.au, complete the financial performance scorecard. Our wealth advisory team works with our clients each and every single day to implement this system and help them elevate their wealth strategy and supercharge their path to financial freedom. Stop reading and start doing. Your wealth machine is waiting to be built. So whenever you're ready to get started, feel free to reach out to us. Hope that you've got a lot of value from this podcast. Make sure you complete the financial performance scorecard and then tune into the next episode where we're going to be going deep into the create piece of sustaining surplus and utilizing the hub structure in order to move that financial needle forwards faster. Look forward to catching you on the next episode.